Welcome back everyone to Hoot and Poop video. So in this week's learning series, I will be talking about options. Now, the previous video, I've talked about stocks. So I hope that video has gave you a understanding of, the mindset behind investing. Now, so this time around for options, first and foremost, options is actually a very, very complicated investing tools. Why I say complicated? Because there are many variations of strategy that you can use. I'm not going to go into that. So my intention for this video is solely to give everyone a brief, or rather a very elementary understanding of what option is all about, the obligations, the rights for different contracts, if I were to put it this way, because options is actually a contract. So without further ado, let's go. Now, I will use some definitions and some examples throughout my whole presentation. So let's start with the basic one. The definition of options, basically, it's a derivative based on the value of stocks. So meaning to say, all right, options is about a contract. So this contract represents some stocks that are trading in the exchange. So for example, Facebook, there are options, SE, there are also options, CrowdStrike, there are also options, to name a few. Okay, so options is a contract between a buyer and a seller. So there's always two parties involved whenever we carry out an options trade. Okay, so on the left, on the right, you can see two of my friends. We have Freddie and we have Nancy. Okay, now for this particular video, okay, Freddie will be the buyer. So meaning to say he will be buying the contract. All right, and Nancy will be the seller. Okay. Now, get things out from definition. So basically, there are two kinds of options: the call option as well as the put options. So every options, regardless of call or put, there will be a buyer and there will always be a seller. So for the buyer, okay, of a call options, basically you have the rights to buy the shares at the agreed price. Meaning to say, being a buyer, okay, you can choose to exercise your rights, right, to buy the shares at that agreed price of stated in the contract. Okay, now, as a seller, you are obliged to sell the shares at the agreed price. Okay, so why do I use obliged? Because if the buyer chooses to exercise his or her rights to buy the shares at that agreed price, now being a seller, you must sell your shares. Okay, now moving on to put option. So basically, for the buyer of a put options, you have the rights to sell the shares at the agreed price. So you can choose to sell or you can choose not to sell. Now, being a seller, you are obliged to buy the shares at the agreed price if the buyer decides to exercise his rights to sell the shares. Okay, that's the difference between the call and the put option. Now, I just want to move on to other terminology. So for options contract, one contract represents 100 shares. Meaning to say, if let's say Facebook share price is $300 as of today, for example, okay, that contract will contain 100 Facebook shares. Okay, so you want to calculate the worth, etc., and so on in a very, very simple ballpark figure. Okay, it's basically you must take the current share price, which is $300, multiply by 100. Okay, now this is just a very ballpark kind of understanding. Okay, agreed price is also similar to strike price. Okay, so strike price is actually what most of us use, most options investor or options traders use, all right, because this is what the more common term that we talk about, but it basically means agreed price, or rather the price stated in the contract. Okay, now the value of the contract is also known as premium. Okay, so basically, how much, what's the value, what's the worth of the contract, and so on. Now, take note, options being a contract, there will be expiry dates. Okay, it's not an infinite thing. It's not like you buy and hold forever like stocks. So there is a there is an expiry date for the contract. So options can be a monthly option or a weekly option. Most of the time, okay, for options investors, okay, or rather myself, I tend to look at more monthly options rather than weekly options. The reason is because monthly options has more volatility, has more higher volume. It means there are more investors looking into the monthly options compared to the weekly one. Okay, but that's just my preference. So take note, the expiry date for the options contract is every Friday for the weekly contract, and for monthly contract, it expires on the third Friday of the month. Okay, so that's what it is. Now, I want to dive deep into call options. So I'm going to invite two of my friends, Freddie and Nancy here again. Okay, so for call options now. Firstly, Freddie buys the contract. So he becomes the buyer of the call options. And Nancy sells the contract and she becomes the seller of the call options. Okay. Now, because Freddie purchased the contract from Nancy, Freddie has to pay some premium out. Okay, and Nancy, because she sold the contract, she will collect some premium because of that. And therefore, the contract now belongs to Freddie. And Freddie becomes a buyer of the call contract. Okay? Now let me go through some of the terms and conditions or rights that both Freddie and Nancy have. So for Freddie, okay, because he's the buyer of the call contract, he needs to pay the seller to buy the contract. Okay. Number two, being a buyer, he can exercise his rights to buy the shares at the agreed price stated in the contract or strike price. Okay. So in order to buy the shares, or rather in order to exercise his rights, Freddie needs to have the cash to buy the shares. Okay, I'm not talking about leverage or margin here for now. I'm just going to keep it very, very simple. So just remember, being a buyer of the call contract, you have to pay the seller, all right, to buy the contract. So basically, you will have to fork out some form of money to buy the contract. Number two, being a buyer, you can exercise your rights to buy the shares at the agreed price. Now, if you choose to exercise your rights to buy the shares, you need to have cash, or rather, the right to buy the shares. And we take note, one contract represents 100 shares. Okay, so just take note of the whole thing. Now, Nancy, okay, being a seller, okay, once she sold her call contract, for this case, she collect cash immediately from selling the contract. Now, she must sell her shares at the agreed price if the buyer decides to exercise the contract and buy the shares. So if Freddie decides to exercise his rights to buy the share, Nancy must sell. So this comes with a huge risk to Nancy if she do not have any shares to sell. Why? If that situation happens, Nancy must immediately, or rather the brokerage will immediately purchase 100 shares regardless of whatever price, right, at the market. And once the brokerage purchase it, and they will immediately sell for Nancy because she needs to fulfill her obligations to sell the shares. So most of the time, if this happens, all right, Nancy will incur huge loss, because if you think about it, by selling a call contract, you are effectively shorting the market. Okay, now I'm just going to give you some terminology here. All right, I will go through in detail, okay, with some examples on what are the different strategies you can use. So for now, just take note of the different rights and obligations for both the buyer and seller of a call contract. Okay, now moving on to a put contract, rather put options. Likewise, we have Freddie and Nancy. So Freddie being the buyer of the put options and Nancy being the seller of the put options. So because of that, Freddie pays Nancy some form of money as premium, and Freddie gets the put options contract. Now, so for this time around, Freddie, more or less is similar. You pay the seller to buy the contract. Okay, and of course, being a buyer of a put contract, you can exercise your rights, but take note of the difference. this time out is your rights to sell the shares at the agreed price. So because you can exercise your rights, or rather Freddie can exercise his rights to sell the shares, he needs to have the stocks. He needs to have 100 stocks, okay, for per contract, if he chooses to exercise his rights to sell the shares. If not, it will be a short selling. Okay, so just take note, being a buyer of a put contract, if you choose to exercise your rights to sell the shares, you have 100 stocks, right, to fulfill your fulfill your rights, or you will consider as short selling, or rather shorting the market. Okay, now on Nancy's point, okay, being a seller, she collect cash from selling the contract. All right, then take note, if the buyer chooses to exercise his rights to sell the shares, Nancy must buy the shares at the agreed price. Okay? And if Nancy do not have the cash to buy the shares, take note, 100 shares per contract, Nancy may end up in leverage, or may even worse, margin call. All right, so just take note of the rights and obligation. All right, so I hope in this video, okay, it gives you guys a brief understanding of options and what's the difference between a call and a put options contract. Okay, so please like and subscribe this video, and do comment below on what are the things that you want me to talk about. All right, and of course, I know this is not enough, and options is really another new form of things to learn. I will be coming out other videos to talk a little bit more on options and what are the different strategies, very basic understanding of what are different strategies you can use with options. Okay, so with that, invest safe.